Hello and welcome back to this week's episode of the Billionaire Investor series. This week I'm going to be breaking down financial terms and concepts that you might just need some clarity on, or you might just be not so clear about. The very first term is investment portfolio. What is an investment portfolio? So when I say I own an investment portfolio, do you own an investment portfolio? What do I really mean by that? An investment portfolio is simply a basket of multiple securities or assets that you might own. So examples of securities that might be part of your portfolio include stocks, also known as shares, that you buy off the stock market as ownership in a company. You could also own bonds, which are usually like, securities that you lend, that governments provide. For instance, the government can issue a bond. Corporate organizations can also issue bonds. They're also called fixed income securities because you basically earn a fixed rate on those securities, right? So, you might have stocks, bonds. You might also have real estate in your portfolio as well. So those are just examples of asset classes you might have. So a portfolio is simply a basket of multiple securities. So when I ask you, what is your investment portfolio like? Do you have an investment portfolio? That's what I'm asking. So if you just tell me, oh, I have a mutual fund, that means you probably just have one investment. It doesn't mean you have a robust investment portfolio. Okay? So I think for every investor, the goal is to have a robust, well-diversified, well-balanced portfolio. So the second term is risk appetite. So what is your risk appetite? Your risk appetite is basically the level of risk you're willing to accept in an investment option, right? So for most people, they're usually conservative or aggressive. So you can either be a conservative investor who doesn't really like to take risk, you are risk averse, you only want to do things that are safe, nothing aggressive. Or you might be an aggressive risk taker, someone who doesn't mind taking a high level of risk, because you want to earn high returns. Remember, the higher the risk, the higher the returns, right? Possibly the higher the returns. So you might be someone who doesn't mind, getting into an investment that is really risky, where you are not necessarily sure you may get your money back, right? But that's fine by you because you're willing to take the risk. So you're either a conservative, risk-averse person or someone who is aggressive and willing to take as much risk as possible. So your risk appetite is basically the level of risk you're willing to accept with an investment option. Now, one of the questions I always ask people is, how much risk can you take? Because there are pros and cons for every investment opportunity. Don't jump into every investment opportunity because your friend is investing or because you know somebody else investing. Can you really take the risk associated with that investment? You need to ask yourself that question. Can you sleep at night? And what happens if you do lose your money? All right? Are you going to lose your sense of your livelihood, right? Your ability to get back on track, right? Is it going to be a huge loss of money to you? You need to ask yourself those very important questions before you make investment decisions, okay? So the third term is what financial experts call the rule of 72. So the rule of 72 is basically a way to estimate how long it will take to double an investment. So basically how long it will take you to earn 100% on your investment. So for instance, if an investment ROI or rate of return is 8%, divide that interest rate by 72. So it will be 72 divided by 8. So that means it will take 9 years for you to double your investment. If an investment is 12%, for instance, 72 divided by 12, that means it will take you 6 years to double your investment, right? So basically the rule of 72 is a way to estimate how long it will take you to double an investment. So if you're speaking with your financial advisor and they tell you, this is the rate on this particular investment option, you can just do the quick calculation in your head, like how long will it take me to double this investment? And then you can compare it to another investment option. But also remember your risk appetite, because the fact that it's a higher return and you might double your investment in 2 or 3 years does not mean that you're willing to take that risk. All right. And also consider your investment portfolio. What other investments or asset classes that are in my investment portfolio. Should I add this to my investment portfolio? Do I want this as a mix in my investment portfolio right now? So those are just, it's making an investment decision or making multiple investment decisions requires you to think comprehensively. It's not something that you just take isolated, all right? It's not an isolated case. You can't take these decisions in isolation. You have to think comprehensively about your basket of securities or assets that you own. You have to think about your risk appetite and also think about the rule of 72. How long would it take me to double these investments? All right. In some cases, you might be fine with waiting 9 years. Some people might want it in 3 years, 4 years, 5 years. It all depends on you. The final term is flipping. And this term has been really abused, really. I see this term a lot on social media, on the internet. People tell you, bring this and we'll flip it and get your money back. The original term flipping really means that you buy an asset, right? You probably renovate it or something, and then you can flip it. That means you can sell it off at a higher price. So it's very popular in real estate. People say that, oh, I bought this real estate at this particular price, I renovated, and then I was able to flip it. That means I was able to sell it off in a short time and make my money back with a profit. It's also very popular in the stock market. In stock market trading, you buy a stock at a good price and you can flip it and sell, make your money back and make a profit. But there's a problem when people tell you, bring your money and I'll flip it for you. You get 100% and 200%, and there's no real asset underlying that investment transaction. If there is no real asset underlying that investment transaction, it probably is a scam. It probably is a scam, and you have to be very careful, right? So if someone says, bring the money and I'll flip it in 1 month, 2 months, I'll give you 50% or 100%, be very careful and ask them, what is the asset underlying this transaction? Is it a real asset? Is it tangible? A lot of people say cryptocurrency, a lot of people say binary options or forex. Sometimes these things are not very true. You have to be very careful and ask the right questions. If you're not very satisfied with the answer they give you, then please don't flip. Don't flip your money. Stay away from flipping, all right? And keep to what you know. So those 4 terms are what I would talk about this week. Investment portfolio, risk appetite, rule of 72, and the final one is flipping. If you have any more financial terms or concepts you want me to break down or explain in very simple terms, because that's what I do, I make investing simple, then please leave a comment in the section below and I will get to it. See you next week.